Welcome to this lesson on overconfidence bias, one of the most common psychological traps in behavioral finance. Today, we're exploring why people often believe they know more than they actually do about money and investing. This bias affects everyone from beginners to experienced investors, and understanding it can help you make better financial decisions. Throughout this lesson, you'll learn what overconfidence bias is, how it shows up in real-world investing, and most importantly, practical strategies to protect yourself from its effects. Overconfidence bias is the tendency to overestimate our own abilities, knowledge, and predictions about future outcomes. In simple terms, it's when we think we're better at something than we actually are. This isn't about being intentionally arrogant. It's a natural human tendency that affects all of us to some degree. When it comes to investing, overconfidence can lead us to believe we have special insight into the market, that we can predict stock movements better than others, or that our investment strategy is foolproof when it might not be. Overconfidence actually manifests in three distinct ways. First is overestimation, where we think our performance is better than it actually is. For example, believing you made a 15% return when you actually made 10%. Second is overprecision, which means being too certain about the accuracy of our predictions. This is when you say the stock will definitely go up tomorrow, rather than acknowledging uncertainty. Third is overplacement, where we believe we're better than others at something. Like thinking you're a better investor than 70% of people when you might actually be average. Understanding these three types helps us recognize overconfidence in different situations. There are three main psychological reasons why overconfidence develops. First is the illusion of knowledge. We often confuse familiarity with expertise. Just because you've read a few articles about investing doesn't make you an expert, but our brain tricks us into feeling more knowledgeable than we are. Second is confirmation bias, where we remember our successes and conveniently forget our failures. You might recall the 3 stocks that went up but forget the 5 that went down. Finally, self-enhancement is our ego's way of protecting us from uncomfortable truths. Admitting we don't know something can feel threatening, so our mind inflates our sense of competence to maintain self-esteem. Overconfidence has specific and costly effects on investment decisions. First, it leads to excessive trading because investors believe they can time the market perfectly, buying and selling at just the right moments. Second, it causes people to take too much risk by underestimating potential losses. They focus on the gains they expect while downplaying the possibility of things going wrong. Third, overconfident investors often ignore research and data, trusting their gut feelings instead. And fourth, it results in poor diversification because people concentrate investments in areas they think they understand well, like their own company's stock or industries they're familiar with. Each of these behaviors can significantly harm long-term financial performance. Research provides compelling evidence of how damaging overconfidence can be. Studies of day traders show that those who trade most frequently, driven by overconfidence in their ability to beat the market, actually earn significantly lower returns than passive investors who simply buy and hold. These active traders underperform the market by 6 to 7% annually. That's a huge difference over time. If the market returns 8% and you're losing 6% due to overconfident trading, you're barely breaking even while a passive investor doubles their money every 9 years. This research demonstrates that feeling confident about your trading ability often leads to worse results, not better ones. It's important to recognize the warning signs of overconfidence in yourself. First, pay attention to your language. If you find yourself saying things like, "I know this will happen," instead of "I think this might happen," that's a red flag. Certainty in uncertain situations indicates overconfidence. Second, notice if you're dismissing alternative viewpoints or contradictory information. If your reaction to criticism is immediate rejection rather than consideration, that's problematic. Third, making quick financial decisions without thorough research suggests overconfidence. And finally, refusing to acknowledge or learn from past mistakes is a clear sign. Everyone makes investing mistakes, but overconfident people, either don't admit them or blame external factors rather than learning from the experience. Fortunately, there are proven strategies to combat overconfidence bias. Strategy number 1, actively seek disconfirming evidence. Don't just look for information that supports your investment thesis. Deliberately search for reasons why you might be wrong. If you think a stock will rise, research reasons why it might fall. Strategy number 2, track your predictions. Keep a written record of your investment decisions and predictions, then review them later to see how accurate you really were. Most people are shocked when they do this honestly. Strategy number 3, get external feedback. Consult with financial advisors, mentors, or knowledgeable friends who can provide objective perspective and challenge your assumptions. Other people can often see our blind spots better than we can. Let's discuss 4 practical steps you can implement immediately. First, create a written investment plan that documents your strategy, goals, and rules, then commit to following it. Writing things down makes it harder to deviate based on overconfident impulses. Second, implement cooling-off periods by waiting 24 to 48 hours before making major investment decisions. This pause allows emotion and overconfidence to subside. Third, use systematic investing by automating your contributions. Dollar-cost averaging removes the temptation to time the market based on overconfident predictions. Fourth, regularly review your performance honestly by comparing your returns against appropriate benchmarks. If you're underperforming a simple index fund, that's valuable feedback about whether your active management is truly adding value. Let's summarize the key points from this lesson. Overconfidence bias leads us to overestimate our abilities and knowledge about investing. It's a universal human tendency, not a character flaw. This bias causes excessive trading, poor diversification, and taking unnecessary risks, all of which hurt our returns. You can combat overconfidence by actively seeking feedback, tracking your results objectively, and maintaining intellectual humility. Remember that recognizing this bias in yourself is the first and most important step toward making better financial decisions. Even professional investors struggle with overconfidence, so staying vigilant and implementing these protective strategies will serve you well throughout your investment journey. Thank you for watching, and remember to stay humble about what you know and what you don't know in the world of finance.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.